You got a pay rise this year, 5%, maybe more. Your boss told you, you felt great, you worked hard for it. So at the end of the month, you check your bank account expecting to see the difference. And the difference is barely there. Your salary went up by 5%. But the amount that actually landed in your bank account, it only went up by about 2%, maybe less. Where did the rest go? It wasn't stolen, there wasn't a mistake on your payslip. The money was taken, legally, quietly, and by design. There is a feature built into the UK tax system that eats a chunk of every pay rise you get, and most people have no idea it's happening. I call this the pay rise illusion, and once you understand how it works, you'll see it every time you look at your payslip. Today, I'm going to explain, from scratch, in plain language, how UK income tax actually works, why your pay rise doesn't give you as much as you think, and 3 things you can do right now to keep more of what you earn. Okay, before I show you the invisible tax, I need to make sure you understand how UK income tax actually works. Because most people get this wrong, and once it clicks, everything else in this video will make complete sense. You're probably thinking, I already know this. I earn money, I pay 20% tax. Done. But actually, that's not how it works. Not even close. And this misunderstanding is exactly what makes the invisible tax so effective. So let me explain it properly. I'm going to use a picture I call the tax staircase. Imagine a staircase with 4 steps. Each step is a different color, and each step has different rules about how much tax you pay. Here's how it works. Your income climbs this staircase from the bottom, £1 at a time. The first step is called your personal allowance. Right now, that's £12,570. Every pound you earn up to that amount is completely tax-free. The government doesn't take a single penny from this chunk. Think of it like a green zone. The money in the green zone is protected. The second step is called the basic rate. This covers everything from £12,571 up to £50,270. For every pound that lands on this step, the government takes 20 pence. That's the 20% you've probably heard about. But here's the crucial bit. It's only the pounds on this step that get taxed at 20%, not your whole salary. Just the pounds between 12,571 and 50,270. Let me say that again because it's the thing most people misunderstand. You don't pay 20% on everything you earn. You pay 0% on the first chunk and 20% on the next chunk. Each step has its own rules. Step 3 is the higher rate. If any of your pounds climb past 50,270, they land on this step. And the government takes 40 pence from every pound here. That's double what they took on step 2. And step 4, for the very highest earners, is 45 pence per pound. Now here's the bit that matters for today. See the edges of those steps? Where one colour ends and the next begins. Those edges are called thresholds. And the thresholds are where the invisible tax hides. Remember them, because everything I'm about to tell you is about what happens at those edges. Now, here's where it gets properly unfair. Okay, so you know the staircase, you know the steps, you know the thresholds, the edges between the steps. Now here's the thing that changes everything. Normally, those thresholds are supposed to move upward every year. The idea is simple. Wages go up over time. Prices go up over time. So the thresholds should go up too, so that the same proportion of your money stays on each step. If your wages grow by 3%, the thresholds should grow by 3%. That way, the system stays fair. But they haven't moved. Since 2021, the government froze them. Let me say that plainly. The edges of the staircase have been glued in place. The personal allowance, the tax-free zone, frozen at 12,570. The edge where you start paying 40%, frozen at 50,270. They're not moving, they're locked. But your wages? They're still going up. You're getting pay rises. The cost of living is pushing salaries higher. So every year, more of your pounds are climbing higher on the staircase, but the edges haven't moved. Which means more of your money is landing on the more expensive steps. More of your income is being taxed at 20% instead of 0. More is being taxed at 40% instead of 20%. And you're paying more tax, not because the rates changed, but because the edges didn't move. This has a name. It's called fiscal drag. But I think a better way to picture it is what I call the escalator effect. Imagine you're in a shopping centre and you step onto an escalator. You're walking upward. That's your pay rise. You're climbing. You can feel yourself moving up. But the escalator itself? It's broken. The belt isn't moving. So every step you take is harder than it should be. And the higher you climb, the more expensive the steps become, because you're being pushed onto higher tax bands that the frozen edges haven't moved to protect you from. That's the escalator effect. Your pay rises, but the system isn't adjusting to match, so you keep less of every raise. Let's say you earn £30,000 a year. That's your total salary before anything is taken out, sometimes called your gross pay. Now, the first 12,570 of that is on step 1 of the staircase, tax-free, 0%. The remaining 17,430 is on step 2, taxed at 20%. So you pay about £3,486 in income tax. On top of that, you also pay something called national insurance. Remember that from episode 1? It's a separate payment to the government that helps fund things like the NHS and your state pension. That's roughly another £2,100. Now you get a 5% pay rise. Brilliant. That's an extra £1,500 a year. But because the thresholds haven't moved, the edges of the staircase are still frozen, that entire extra £1,500 lands on step 2, the 20% step. So 20% goes to income tax. Another 8% goes to national insurance. That's 28% of your raise taken before it reaches your bank account. You earned an extra £1,500. You kept £1,080. Your 5% pay rise became a 3.6% pay rise. And you probably didn't even notice. Let me show you what this looks like with actual numbers, because this is where it gets real. But that's not even the worst part. Because for some people, fiscal drag doesn't just shrink your raise. It pushes you onto a completely different step of the staircase. Here's where fiscal drag goes from annoying to genuinely damaging. I call this the threshold trap. Remember the edge between step 2 and step 3 on the staircase? That's the threshold at £50,270. Below that edge, your pounds are taxed at 20%. Above it, they're taxed at 40%. That's double the tax. So crossing that edge is a big deal. Let's say you earn £48,000. You're comfortably on step 2. 20% tax on everything above the tax-free zone. Then you get a 5% raise. That takes you to £50,400. And now, £130 of your income has crossed the edge. It's on step 3. Those pounds are now taxed at 40% instead of 20%. Now, to be clear, you're not paying 40% on everything, just on the pounds that crossed the edge. But here's the trap. Every single raise you get from now on, more pounds cross that edge. And the edge isn't moving, it's frozen. So every year, a bigger chunk of your income lands on the expensive step. You're probably thinking, but I earned more, so I should keep more. And technically, yes, you do keep slightly more in total. But the percentage you keep gets smaller every year. That's the trap. It feels like progress, but the system is quietly clawing back a bigger share of every raise you get. And this isn't happening to a handful of people. The Office for Budget Responsibility, that's an independent group that checks the government's sums, estimated that by 2028, frozen thresholds will have pushed over 3 million people onto step 3 who would never have been there if the edges had moved with inflation. 3 million people paying 40% who weren't supposed to be. So the system is designed this way. The edges are frozen, your wages keep rising, and the gap between what you earn and what you keep gets wider every year. But here's the question you actually care about. Can you do anything about it? The answer is yes. But not in the way you might think. You can't change the thresholds. That's a decision made by the government in something called the budget, which is an annual announcement where the Chancellor, the person in charge of the country's money, sets the tax rules. So you can't move the edges of the staircase, but you can change how much of your money is exposed to the expensive steps. Here are 3 things you can do right now. 1. Check your tax code. If you watched episode 1, you already know about this. Your tax code is a small code on your payslip, usually something like 1257L, that tells your employer how much tax to take from your pay. If it's wrong, you could be paying too much tax before the escalator problem even kicks in. This is the easiest thing to fix, and it's the first thing to check. The government has a free online tool called a personal tax account. You set it up on gov.uk. It takes about 10 minutes. Once you're in, it shows you exactly what HMRC, that's the government's tax department, thinks your tax code should be. If it's wrong, you can get it corrected and claim back anything you've overpaid. Go to gov.uk and search for personal tax account. Set one up if you haven't. Check that your tax code matches 1257L. If it doesn't, call HMRC on 0300 200 3300. It's a free call and they can fix it. 2. Use your pension to beat the staircase. Now, this one is clever, and once you understand it, it completely changes how you think about your workplace pension. Remember from episode 1, a pension is a pot of money you save for retirement. Your employer puts money into it, you put money into it, and the government gives you a bonus called tax relief. The money grows over time, and you get it when you retire. But here's the part most people don't know. Some employers offer something called salary sacrifice. Let me explain what that means in plain English. Normally, you get your full salary, the government takes tax and national insurance from it, and then whatever is left goes to your bank. With salary sacrifice, you agree with your employer to take a smaller salary on paper. The difference goes straight into your pension. And because your salary is now technically lower, you pay less tax and less national insurance. Think of it this way. You can't move the edges of the staircase, but you can move your income below them. Every pound you put into your pension through salary sacrifice is a pound that doesn't climb as high on the staircase. It avoids the more expensive steps. If you're near the edge of step 3, around 45 to 55,000, this is especially powerful. Every extra pound into your pension could save you 42 pence in tax and NI that you would have lost. Even if you're a basic rate taxpayer on step 2, salary sacrifice saves you about 28 pence for every pound you redirect. That money isn't lost, it's growing in your pension pot. It's still yours, it's just protected from the staircase. Ask your employer or HR department, do we offer salary sacrifice for pension contributions? If they do, consider increasing your pension contribution, especially if your salary is near one of the staircase edges at 12,570 or 50,270. If you're not sure what's right for your situation, speak to a financial advisor. Money Helper is a good starting point. 3. Know your numbers. The most powerful thing you can do against the escalator effect is simply know where you stand. 3 specific numbers. First, how much of your last raise did you actually keep? Look at your payslip before the raise and after. Compare the net pay, that's the amount that actually reaches your bank. The difference tells you what you really gained. Second, how far are you from the next threshold? If you're earning 46,000, you're 4,270 away from step 3. Knowing this lets you plan. Third, what's your effective tax rate? Most people on 30,000 pay an effective rate of about 11 to 12%. But they don't know that because nobody shows them. Once you know these numbers, fiscal drag stops being invisible. You can see exactly what's happening. Pull up your last 3 payslips. Find 4 numbers on each one. Gross pay, net pay, tax paid, and NI paid. Then work out how far your gross pay is from the next threshold. The free starter kit in the description walks you through this with screenshots and a simple worksheet. Quick note, I'm not a financial advisor. I'm a researcher. Everything on this channel is financial education. That means I'm here to help you understand how things work, not to tell you what to do with your specific money. For advice about your personal situation, speak to a qualified professional. I've put links to free guidance in the description. Fiscal drag isn't going away. The thresholds are frozen until at least 2028, and the government has no incentive to unfreeze them because frozen thresholds quietly raise billions of pounds in extra tax revenue every year. No announcement, no headline, no vote, just edges that stay still while everything else moves. You can't fix the escalator. But you can stop pretending it's giving you the full ride. Check your tax code. Use your pension strategically. Know your numbers. The system won't explain itself to you. That's what this channel is for. Subscribe and hit the bell. The topics on this channel build on each other. Miss one, the next won't land the same. Next week, we tackle the biggest myth in UK savings. 44% of Brits think ISAs give you some kind of government bonus. They don't. And the difference between a cash ISA versus a stocks and shares ISA over 25 years? About £41,000. I'll explain what ISAs actually are, how they work, and which one makes sense for you. All from scratch. That's pounds and cents.